Welcome to the Remarkable Retail Podcast, Season 3, Episode 10. I'm Michael LeBlanc.
And I'm Steve Dennis.
Well, Steve, once again, you and I get to chit and chat together. It's you and me, projecting from that great Canadian actor, Rick Moranis, and his classic Honey, I Shrunk the Kids, to Steve, I think we've shrunk the store. And that's what we talk about a little bit later. But before we get into that, let's talk about the retail news.
Busy week.
We never talk about these guys, so I'm really thrilled we bring them back up. Amazon.
Yeah. I'm sure they're very neglected. I'm surprised we haven't gotten any nasty grams from the PR department.
Let's talk about Whole Foods. So a couple of things are happening at Whole Foods. First of all, on a business level, they've added back in a delivery fee. So let's start there. So tell me about that. And this, as I'm sure everyone knows, Amazon owns Whole Foods, but let's start talking about this delivery fee thing.
Well, one of the big features of Prime has been that there is free 2-hour delivery built in, or there was free 2-hour delivery built in, but they announced this week that they are going to eliminate that, and there is now a $9.95 charge for 2-hour delivery. Still free 1-hour delivery for Prime members if you want to go pick it up. But this is a pretty big change. They were testing it in 5 or 6 markets for a while. But yeah, they just announced that that's going to go everywhere, which has gotten, number one, a lot of pushback online from customers complaining about it, feeling like they kind of changed the deal in terms of Prime membership, which is a paid membership. But of course, nobody likes price increases. But to me, what's interesting about this, and I kind of think the folks in Bentonville and Minneapolis and other places were breathing a sigh of relief, because as we've touched on a bunch of times, the cost of grocery delivery is generally pretty prohibitive for the retailers. So to the extent this either allows more people or more retailers to charge to get some of that money back, or encourages more customers to come to the store, which I suspect will be the bigger effect, that's a much better financial outcome for retailers.
It's been an interesting journey, right, with Amazon buying Whole Foods. I mean, if you cast our minds back a couple of years ago, the announcement was made. It was, oh my God, it's the end of grocery. And I think it took like $1 billion out of the market, which was just fantastical, just ridiculous, because, at the end of the day, it's a 400-store chain, 450 stores, is about 14 in Canada, I think, close to 400 in the U.S., It's positioned at a certain price point. I thought when Amazon bought it, I was going the other way. I thought they were catching a falling knife, basically. I mean, Whole Foods was not doing spectacularly well, and I didn't really see the fit. I didn't see the fit culturally. I didn't see why they needed to. I mean, there's other groceries you could buy. They paid, $14 billion for them, and Amazon can pay any amount of money. They could have bought anybody, practically.
Yeah, I mean, in the scheme of things, it's a relatively inexpensive experiment. You can argue, a lot of people have had thoughts on whether this was really the way for them to learn about the grocery business, that they had designs on a bigger plan, which they seem to be executing now for mainstream grocery. Because you're entirely right. Whole Foods, in the scheme of things, is very much a niche player. That's not where the big money is. It's going to be much more where they're going with Amazon Fresh. But the other thought was, okay, well, it's a more upscale consumer, and if they get more data about the upscale consumer, perhaps that helps them in the fashion business and some other aspects of their growth plans. I don't think that's paid off so much, but maybe the grocery part has been good R&D for them.
All right, well, let's enough about Amazon. Let's talk about earnings, another batch of earnings, and some information on Warby Parker. What have you distilled from this week's earning calls?
Well, a lot of just general retail market activity. So the 3 earnings announcements I thought were the most interesting. Let's start with the good news. The good news for the most part was Costco, which had, I want to say, about a 10 or 11% sales increase and an even better earnings increase. So those were pretty strong numbers, even though they alluded to concerns about inflation, supply chain, and all that kind of stuff. So they managed some pretty good numbers despite some of those headwinds. And also, I would have thought, this has come up several times where with COVID being a little bit less of an issue, that grocery isn't having the kind of banner year as people go back to eat out more. And Costco's not a traditional grocer; they've got a mix of other stuff. But I think Wall Street was expecting that their sales might be tamped down a little bit, and they weren't. So that was pretty impressive. On the flip side, well, let's say the moderate side, Nike's earnings were actually pretty good. I mean, their sales, a good solid sales growth. Most people would be happy with the kind of sales growth. I think it's like 19% or something in the US, 11% in China, which was a little bit low for them. Their margins were actually pretty good, but people got pretty concerned because they talked about all the supply chain challenges they're having, and they basically guided much lower for the balance of the year, and I think into next year. And I think we talked about this maybe a few weeks ago about how much product Nike, but others are having made overseas and in Vietnam in particular. And Vietnam just nothing's coming out of there, and it doesn't look like much is going to come out of there for quite some time. So that was a big damper on Nike.
Talk about Bed Bath and Beyond numbers.
Yeah, well, the train wreck, I guess you could say, which is probably charitable in the earnings announcements. Bed Bath and Beyond, folks may know, certainly it was struggling for quite a long time, but they brought in a whole new leadership team, Mark Trident from Target most notably, but a whole bunch of other senior executives. And they've been implementing not only extensive private brand programs, remodeling stores, bringing in new brands. And so they actually were posting some pretty good numbers, seem to have some pretty good momentum. And then they announced this quarter where sales retreated significantly. And they talked about how traffic, I think I don't have the number in front of me, but the traffic to their stores in August was down 20-something%.
Wow.
On the one hand, you could say, well, yeah, COVID in certain areas has kind of come back, but that seemed to be really out of whack with what a bunch of other people are reporting. They also, like everybody, are talking about supply chain, cost of goods, inflation, those sort of things. And so both the warning aspect that we saw in a lot of retailers, but in particular the traffic declines caused people to run to the exit. I think the stock was down 20-25% the day of their earnings announcement. So that's a little bit mysterious, not good news. The other kind of market news is what I would put under the kind of IPO boom heading, which is a number of retailers, some of which we talked about in the past, like Allbirds and Warby Parker going public. But we've got Guitar Center, Claire's, Mattress Firm. So you got these kind of hot, sexy brands like Allbirds and Warby Parker going public, and then you got these other three brands which were bankrupt last year or so, also going public. Yeah. So we'll see how that sorts out. But the one that did actually go public this week was Warby Parker, which we talked about with Dan McCarthy a couple episodes, I guess, at this point. And they went public. Stock rose a lot. I believe they closed as we're recording this.
50%. I saw.
It spiked a lot. Where it's sorted out, I haven't looked at the market today. We're recording this on Friday, but their valuation at the close of their first day of trading was about $6 billion. Fun fact: same day, I think Bed Bath and Beyond, with their announcement, their market value is $2 billion. So here you've got this, really well-known retailer with 800-900 stores, I guess, multi-billion-dollar business with a $2 billion valuation, and then Warby Parker, which loses money and maybe does $600 million in the year ahead, $6 billion valuation. So,
all right, let's move on. Let's talk about Target. So they're making an announcement around holiday. Tell me about what you perceive of their latest announcement.
Well, pretty much they're kicking off the holiday season October 10th, which is a little early. I think most people would say. On the one hand, as probably everybody knows by now, particularly if you've been in retail for a while, the holiday season, the Christmas season just seems to keep creeping earlier and earlier and earlier. So to a certain degree, not that surprising, but I guess they're kind of officially kicking it off with their holiday deals. But I think a lot of this, aside from just kind of cutting the line and trying to get out there before Amazon or Walmart and everybody steals their thunder, is a lot of the supply chain issues. I think that this story about products being in short supply, I think is transcended from just being industry insider kind of stuff to a consumer story. So I think this is largely in response to what consumers are likely to be doing. So I suspect we will see every other retailer on the planet probably do some version of a competitive response, exactly what that looks like. But yeah, I think Christmas is going to come early, whether it turns out to be a lump of coal or not. We'll see.
So there's been this big company that when everybody says, I was on a panel this morning, e-commerce, you'll die without it. You got to be omni. Everybody goes, but wait, there's one very successful retailer that has no e-commerce that might be coming to an end. Talk about that.
Well, really kind of the whole category of off-price retail, which I'm sure most people know, the off-price category, TJ Maxx, Ross Stores, Burlington, a bunch of others, has been one of the fastest growing categories for a decade plus. Most of these retailers have opened, hundreds, if not thousands of stores and have seen good growth, but virtually no e-commerce. In fact, I think it was Burlington that had e-commerce and then closed it down in COVID, which was seemingly counterintuitive. But HomeGoods, which is the home furnishings off-price division of TJX, they announced this past week that they are going back into e-commerce. So that was a little bit of a counter narrative. I guess two things I'll comment on. One is I always thought it was a little bit funny, and it gets to kind of this whole siloed thing of thinking about e-commerce having to be a transaction channel, as opposed to, yes, being a transaction channel, but also being an enabler of store sales, and particularly with buy online, pick up in store. There's this intersection between physical and digital that's important. Yeah. Also, maybe you want to go see whether there's inventory in the store before you go down there. And so to me, it wasn't so much about e-commerce as a transaction channel. It was really digitally enabling across channels. But the pushback from the off-price retailers, which I will say in my experience is mostly BS, is that, well, we don't know what we're going to have. So how could we possibly put it on a website? And, they like to create this illusion that everything is like, fell off the back of a truck, and that's why it's such a great deal. But, so much of the product for these stores is made for them. So they absolutely know what they have. And yes, there is a portion that's more treasure hunty, but, so I think there has been a little bit of a smoke and mirrors game. But a big part of it, which gets me to my second point, is concerns about profitability, because the price points are fairly low. And as we've talked about, returns are quite high. So there is a real concern about how to profitably do e-commerce in the off-price channel.
Well, all right. That was our news of the week. Now, before we get to our you and me just chit and chat, and I want to remind the listeners, or conversely the viewers, well, if you're viewing this, you already know we have a YouTube channel, and it's bonus content, because you and I chit and chat for actually closer to 20 minutes, half an hour. But we kind of, for time, we kind of trim that down to about 10 minutes. But if you want to hear our full discussion, we get into some fun stuff back and forth. Visit our YouTube site and just look for Remarkable Retail, and we'll be there. But for now, let's get into this Honey, I Shrunk the Store discussion. So let's kick it off. Well, Steve, we're back on the mic talking about stores. And in this instance, in this episode, you and I wanted to talk about small stores. Let's start at the beginning. Why would we talk about? Why would we have an episode around small store strategy? What's on your mind?
Well, the primary reason, I think, is we've seen a pretty significant uptick in retailers either opening or announcing they're going to open smaller store formats. So when we think about some of the large legacy retailers, we've got Macy's with their Market by Macy's concept. They just opened Bloomie's. Express is going to do a store called Edit. Target's I think they've got 50 or so smaller stores, either their urban city store or these university campus stores, IKEA, Amazon. So there's just a lot more activity on the part of legacy retailers with these smaller store formats in the last really 6 months or so. And then, even though it's kind of a different thing, a lot of the digitally native vertical brands, as we've touched on, are accelerating their store strategies and going about it in a different way. Largely showrooms, so they're pretty small format stores. So I think it's a little different thing. But yeah, there seems to be a real uptick. And actually, I expect we're going to see even more of this as we move ahead.
Let's talk about it. Is this something that was brought on by the COVID era, by the development of changes in retail? Is this all that new, that retailers would examine different formats and different sizes?
I don't think fundamentally. I think there's some different things going on here, but I was thinking about this prior to getting on the mic here, I've worked on quite a few small store formats over the years. Way back in the 90s, when I was at Sears, Sears was experimenting with quite a lot of, I guess you'd say, kind of category specific stores. So instead of building a mall, taking one of the categories they were known for, like hardware, mattresses, appliances, and opening these more focused stores, which I think is fundamentally about leveraging a strength, getting closer to the customer, maybe attracting a slightly different customer with a different location. I also worked on two things at Neiman Marcus more recently. One was a concept we called Cusp, which is a specialty store really focused more on kind of the modern luxury customer. And the thrust there was, we could open a lot more of these locations in theory than the big full-line Neiman Marcus stores, and easier to find locations. You don't have to be part of a big mall. But the idea was really to go after a slightly different customer, younger, lower price points. Barney's did that with their co-op stores as well. So I think certainly you've got one thrust, which is let's reach lower, let's go after different customers with, say, lower prices. So that's very much behind an outlet and factory stores. So those stores are generally much smaller than kind of the mothership. These category stores, like I mentioned, as well as Amazon Bookstore, Amazon 4-star. There's definitely a slightly different angle, which has been around for a while, which is to right size your store to make really expensive real estate work. So most often we see that in urban centers. So Walmart's got these neighborhood stores, not a lot of them. Target's got their city concepts. And then the other one, which I also actually tried to clean up a bunch of years ago, is the idea that you right size a store for smaller markets. So secondary cities, lower markets, and Kohl's, Best Buy, many others have been doing that for a while. Sears was on this, also did this for quite a number of years. So there's different motivations. And like we said, the digitally native vertical brands are going after stores as really, in addition to just being online only, to reach more customers, lower cost of customer acquisition, those sort of things. So I think we have to really think about what you're trying to do. But the new thrust, I think, is a little bit different, which maybe we can kind of unpack a little bit what seems to be driving it today versus what we've seen over 15, 20, 25 years.
Yeah, I can think of a couple of things that would drive it differently, but just to hang on your ideas about there's different pros and cons to each, right? We should probably unpack those for a minute or two. I mean, taking a store and shrinking it and trying to keep, particularly if it's a big store with a broad assortment with lots of different categories, that feels to me like you wind up good at everything but not great at anything, because you've got a smaller assortment. Maybe it's not what people are looking for. I mean, there's some grocers here in Canada that have neighborhood stores where they take their huge box store and put it in a small store neighborhood, and it's great real estate strategy, but it suffers from assortment, right? There's not the assortment people were expecting, and so in one case, Sobeys actually just changed the brand. They bought a brand called Farm Boy, and it just suited a smaller urban market. So they just start converting them all to that. So that brings up the other issue is you're starting to meddle with the brand a little bit, what people expect. I see it, back in our history, your history, open up if you're Sears, you open up a tool destination or a big ticket destination. But what are the pitfalls? Is that when you would go through, or you would today start to advise people about what to think about?
I certainly think when you have a well-known brand and there's an expectation of what that brand stands for, and then you open essentially a watered-down version of that brand, that can be pretty tricky. Way back when, like I said, I worked on trying to clean up the Sears smaller stores. And the issue there for sure, it was one of two things. When we first opened them, which was way before my time, it was back like in the 70s and 80s, they were fairly competitive and they were bringing something new to some of these secondary or tertiary markets. But as soon as Walmart came along or Target came along or whatever, suddenly they were just not competitive. So there were a set of stores that just weren't competitive. Then there's this other issue, and I'll just use as an example. Some folks may remember that Saks probably 20, 25 years ago were opening these Main Street stores. And they were quite a bit smaller than the typical Saks store, but they were also going into kind of secondary cities like Charleston and suburbs of New York and things like that. And that was a big disappointment because it was really just a little bit of everything. And so I think you have to be very careful. Now, just to use the Saks example again, I think if you've got a powerful reputation in a particular category and there really isn't a competing Saks store that's not too far away, or there isn't really a great set of competitors, that maybe can work a little bit better. But like what we did when we opened the custom stores at Neiman's, we were very careful, first of all, to give them a different brand name and really kind of say, brought to you by Neiman Marcus, as opposed to leading with that.
Yeah.
And it was very clear because these stores were 8,000 square feet, not 150,000 square feet, and located in some different areas, that it was not at all a Neiman Marcus store. Now, for various reasons, that strategy didn't go forward, and the contemporary custom is basically now the contemporary department in a Neiman Marcus store. But I think, it's very important to both understand the expectation about the brand and either not water it down or go about it in a different way, but also just be really mindful of what the competitive set is. So on that example, we're talking about that. I suspect the reason why the city targets work is because there's strong affinity towards Target in general. And where they tend to put these, there aren't good alternatives, because it's just too hard. There's no huge Walmart, down the street, or you're taking public transportation. And so just the hassle of getting there. So that's a really different thing than somebody just, jumping on the highway and driving 10 minutes to get to, the real Target or the real Walmart or the real Nordstrom.
Let's bridge over to current events. So as I think about what we're talking about, smaller stores, I think about two things. One is the work from home readjustment in the workplace. So that may be, smaller than it is today, maybe bigger than it is today. But there's no question when I talk to retailers, they tell me their downtown stores are struggling a bit. Their urban stores are growing. Maybe, they were planning to put more stores in urban markets. So maybe that's a real estate play. And the second thing, of course, is e-commerce. So when you say, you didn't have the Target assortment in the smaller Target stores where you have it online. How do these two things in your mind play together in the current environment?
It's one thing to, I guess the way I think about it is, it's one thing to optimize, so to speak, your store for a new situation. So generally, it is true that by virtue of e-commerce, your stores don't necessarily have to be as big, and you can still meet the customer's promise, particularly if the things you're taking out are more commodity-like. So I think you really have to understand the customer, why they're coming to your store. Is it an add-on item? Is it something that they really want to see, touch and feel, maybe get sales help? So I certainly think with some formats, you can have a smaller store, but it's really more optimization as opposed to really thinking about your go-to-market strategy in a fundamentally different way. So that's why I think when we talk about what Target is doing or some of these large retailers with their newer stores, it's still basically their full version store. They're just tweaking it for kind of this new environment. It's a different thing. And you mentioned Nordstrom Local. It's a different thing to really say, okay, we want to build a really different format to serve a really different role. And so Nordstrom Local, which I know we've talked about a few times on the podcast, is only a couple thousand square feet. And there is no merchandise offering for take with business. So it's really obvious it's not anything like a Nordstrom department store. But what they're doing is kind of surrounding the Nordstrom full line stores to make these stores more of a service concept. So buy online, pick up at store, buy online, return to
returns
store.
And all that. Alterations.
Right.
Yeah.
And so, that is extending their reach and doing so in a much more capital efficient way.
And brand consistent, because you're getting the best of both worlds. You're not setting expectations that this is a Nordstrom in what you're traditionally thinking about it, right?
At the risk of stating the obvious, I think that, part of the way you get to this, because I've been asked this question a bunch of times, and it's hard to say, there's just one rule of thumb for all of retail, because there clearly isn't. But start with the consumer. Are you really solving a problem for consumers? I think in the case of Nordstrom Local, it's a hassle for many people. If what they want to do is pick up an order or exchange something or just get some alterations done for something they ordered online, in many cases, it's a real hassle to have to go to the full-line Nordstrom store because it's not close to their home or office in many cases. You got to deal with the parking deck, go up the escalator, the whole bit. So they're really leveraging strengths they have, but going after a few specific issues. If you want to go see the whole assortment, presumably it's worth driving an extra 15 or 20 minutes or planning for it as opposed to running into a Nordstrom Local after work or what have you. So I think you're really... a lot of cases, if the retailers are really just kind of optimizing a store to get the return on assets to be better, well, what are you taking out? And is the thing you're taking out really undermine why customers go to you in the first place? And so I think that's why we've seen some of these strategies fail. So you have to start with the consumer. You always obviously have to pay attention to the economics and the trade-offs and so forth. But I think we're going to see more of these kind of not necessarily singular purpose stores, but kind of more service oriented stores. The other thing I think is really specific to, well, not unique to just department stores, but I think is a real challenge to department stores. And I know we touched on this in a recent episode a bit, is if you're a large department store with this vast offering and you're continuing to close stores, you are making yourself less convenient to the customer who wants to go into your store, whether that's to see the merchandise, get sales help, or do a return. So I think the challenge, so just for completion here, just to remind people, so Macy's is pursuing a few small store strategies. One is their outlet store strategy, which, we've already kind of talked about the reason for that. I think that strategy is probably 20 years too late, but, it's not inherently a flawed idea. Then they're trying these two other kind of specialty store concepts, one called Market by Macy's, and one which is Bloomies, which is a small store version of Bloomingdale's, which is part of Macy's. And here, these stores are much smaller, like 22,000 square feet, and they're edited, curated, as we like to say, but still a little bit of everything for everybody. And they've added some features and they're more modern and there's some cool technology and everything. But that, on the one hand, gets Macy's closer to the customer, particularly where they may have exited markets. But I think the question will be, how do they really develop that business? Who are they stealing market share from? Does the customer really need it? And I don't know the answer to that question. I do get a little bit worried that they may be really just kind of a watered down version of Macy's. And people may end up, like in the case of Bloomingdale's or Bloomies, that store outside of DC is like 10 minutes on the expressway or on the highway up to the Bloomingdale's store. And so, that's a really interesting trade-off. So they just opened, we'll see how that works, but that's a little bit different challenge, I think, to make those concepts work, because it could come across really as just a watered down version or not competitive with the set of retailers that are in the immediate trade area that they have to steal business from.
Well, I like how you always bring this back to those two elements, many elements, but the whole what's in it for the customer, first of all. And then second, where's the sales coming from? Like, who are you taking share from? Now, we're in a weird time when there's retail growth everywhere. It seems, according to Rod from our last episode, there's lots of growth to be had and less products to be had, but that won't last forever. So it's who are you grabbing that market share from?
I think you want to be able to not only have an offering that's of interest to the customer, competitively differentiated, all the stuff we just talked about, but realize that the role of your store, and in many cases, has a much more important service function going forward. And also, this marketing role, we've talked about that a few times. I think if you're Nordstrom's, your Macy's, whatever, having, it's a billboard, right? If you're just driving by. So that, again, that's, I think, a particularly vexing issue for the department stores that are retrenching, Like here in Dallas, and I think, separate episode probably on JCPenney, but Dallas is where Penny's headquarters is. And they've closed, I don't know, 6 or 7 stores in the last couple of years. And so, and there are quite a few more, competing stores, whether you think about it as Macy's or Target or Kohl's or what have you. And so, they've made their brand less convenient for customers to go into and shop, but they also have reduced their marketing impression. And so as customers are driving around or going to a mall or going to a particular shopping center, they're seeing TJ Maxx a lot, and they're seeing Ulta a lot, and all these other,
just not being thought of,
brands.
right? Yeah, you're just
you
maybe you don't dislike JCPenney or whatever. You don't think ill of them. You just don't think of them at all, and that's part of that problem, right? I guess if you close stores in that strategy, you better gear up your other marketing. Maybe put flyers on people's doors, because people forget about your brand real quick.
It also, I think, causes retailers, and I think this is the longer term issue and why I fundamentally think we'll see more of these is, and we touched on this in the hybridization episode a month or so ago, but like, for example, if you look at what Nike's doing, Nike is developing a bunch of different formats for a given market. So they can have potentially these, and probably only in major cities, the House of Innovation, which is like the best of the best, real draw store, cool
experience
technology.
Store, as we used to call it.
and large, very large.
Yeah.
Then they have more of the Nike format we've seen for a while, which is a good feature, but not quite so elaborate in malls. But now they've got Nike Live, which is a smaller store, more local, more kind of a membership model. They've got Nike Rise, which is kind of in between the House of Innovation. And so, for all I know, they may have pickup only stores, right? If you want to order something on Nike on Nike.com and want to get it close to your office, maybe they got pickup lockers or something like that. So I think you have to step back and say, well, what are all the things we're trying to do to grow share of wallet with our customers, extend our reach, deal with convenience, which in some cases is, .com. That's the way to make it convenient.
And deal with unit economics, as we both observed from our last episode with Rod Sides. He's such a funny way he put it, but it was very clever. The consumer's part of the supply chain. They're the last mile. They come and pick it up, and that changes unit economics fundamentally.
Yeah, and what's interesting to me, and unfortunately, I think it tends to favor the newer, the kind of disruptor brands is, so whether we're talking about digitally native vertical brands or, maybe these delivery models or what have you.
Indochinos of the world or whatever. Yeah.
Well, they're leveraging, in many cases, a low cost of capital, and they're getting to, when they expand, they get to open the latest and greatest thinking, and with all this knowledge about where retail is moving. So to your earlier point, if we are going to lose some business in the urban cores and go more, say, to suburbia or different types of centers, the guys that are able to open a lot of new stores, well, they get to put that format there. And then you've got the Macy's of the world that are like, oh, crap, we got 600 or whatever they have now, these huge stores. And if we had to do it all over again, we'd probably put, this new thing across the street, but because that's kind of where it wants to be. But we already got this big investment. So I think it's harder, not impossible, for some of the legacy players to move. But someone like Nike or Nordstrom, I think among the established players, they're a little bit better positioned because they're not so trapped in all this old massive real estate that it's kind of fully depreciated. So anyway, we'll see. So I think that's a challenge, kind of the innovator's dilemma. If people are familiar with Clayton Christensen's book, that some of these insurgents have the advantage of, a bunch of advantages. Some of them are cultural as well, new technology, blah, 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 all the things that make innovation hard. So we'll see. I mean, I think, but like I said, I think there's going to be this desire to really develop a more hybrid strategy on the part of different physical formats, but certainly linking them or very much recognizing the degree, what e-commerce does to the economics, the different ways of doing fulfillment, whether you go to store, have it home delivered, et cetera. So it's a really, really interesting time. And certainly we've got to get post-COVID to understand exactly how this is going to sort out. And as we talked about at the outset, some of these, or many of these new small formats have just opened, or there's only 2 of them. So it's pretty hard to extrapolate to where we're going to see hundreds of these, or maybe none, or a few dozen.
Yeah, I was gonna say, let's go to Vegas and make a bet on how much and how deep the strategy goes. But I'm actually very optimistic about the future of retail innovation from a store perspective, because I think in the past 18 months, generally retailers have been just trying to get through whatever comes at them next. But then thinking in the background about, okay, now what? And I think we're going to see this flourish of innovation, whether it's small stores, whatever it is, but specifically around small stores. You've had acceleration of e-commerce, moderation, people are picking things up, unit economics. There's so much going on. I'm pretty excited actually about the future, and about once we get past all this, which as I've always seen, you can see the end zone, the goalposts keep moving a little bit, but I think the real estate and store innovation is yet to come, and we're going to have a very exciting couple of years. So it's a great topic for our discussion today. So as the radio folks or TV folks will say, why don't we leave it there, and we'll pick it up on another episode. We got a lot of great guests coming up, but for now, let's wrap up and see everyone next week. If you like what you heard, please follow us on Apple, Spotify, Amazon Music, or your favorite podcast platforms, so you can catch up with all our great interviews. Subscribe so that just automatically shows up. Tell your friends, and also in new insights and new episodes will show up every week. So tell your friends, because that will help us share the word, the good wisdom. Now be sure and check out us out on our new YouTube channel. Not so new anymore. We got a couple of episodes up there, and just look for Remarkable Retail.
And I'm Steve Dennis. You can check out more of my work at my website, stephenpdennis.com, or on Forbes, or on Twitter. And please check out my second edition of my book, Remarkable Retail, How to Win and Keep Customers in the Age of Disruption, available just about everywhere books are sold.
And I'm Michael LeBlanc, producer and host of the Voice of Retail podcast and a bunch of other stuff. You can find me on LinkedIn, learn about me on meleblanc.co. All right, Steve, great episode. Look forward to chatting again next week. Be safe and have a great rest of your day.